Regulation is clearly here to stay, and it really comes in two forms. One is in terms of investor protection, and the other is in terms of risk mitigation inside the infrastructure of the industry itself. Clearly our clients, and I don't speak for our own clients, but the industry as a whole, in terms of beneficial owners in securities lending, are fully aware that change is coming. It affects them in different areas. One is that it depends on the nature of the actual underlying fund or clients. So, for example, those that are UCITS compliant clearly know that there are changes to UCIT regulation, which means that they are going to have to perform certain functions. And largely, we're working with those clients to walk them through how those changes might affect them when they engage in securities lending. Notwithstanding the fact that we are completely aware, as they are, that this is an optional function, and that what we're largely experiencing with clients is a debate, and a healthy one, as to how these changes might affect their revenue stream, and whether in fact that revenue stream is going to be consistent going forward. We find in the industry, and it's my experience, that most regulation, whilst on the outset can appear to be somewhat onerous, it usually leads to some opportunity as well. Some of the collateral requirements under the UCIT guidelines, for example, will change the nature of demand, and for example, into high quality assets, there will be a greater demand to borrow those under not just ESMA guidelines, but under other developing regulations such as EMIR, the collateralization of OTC derivatives. So in general, our clients are informed, they are aware that they are going to have to, at times, adhere to their own sense of compliance with changes to regulation. They're also very keen to hear how it might affect their potential revenue stream from this activity. CCPs are clearly, we talk outside of the securities lending market for a moment, here to stay, and in fact there's almost a compelling reason why a number of OTC derivatives, for example, activities are going to have to pass through a CCP, and that has been made clear. So obviously the debate leans itself to, well, what will happen to securities finance? Currently you have a very much of an OTC market. It is less opaque than it used to be with the rise of data providers that are allowed for benchmarking performance purposes. But in a sense, what do we really have at the end of the day is a beneficial owner with a supply of securities that are in demand by a borrower. And if you can make, or if the industry makes that distribution more attractive, if the fees and the cost of using a CCP are neutral to less than the cost that they would incur by the continuation of the current practice, then there's an argument to engage with them. The fact that borrowers will get capital relief through a CCP is given, and that's understood. But the marrying up of that demand with me as an agent having to represent my underlying beneficial owner and to explain to that beneficial owner how they will take advantage of this engagement is still open. However, I do believe now that at some point there is more of an inevitability to an engagement in some asset classes for some types of transaction in the future that will probably be given more credibility, and more activity will come from this, because I think we see the demand side of this equation changing with a greater engagement in the future. Very interesting you mentioned the UAE, because I gather that as of next May they will now they will be granted emerging market status. That's obviously going to attract institutional investment at some point, and that lends itself to our clients having exposure to those countries. Now, obviously from there we lead into, well, are we going to lend in those markets? So what's the infrastructure look like internally? What are the taxation, the local taxation applicable to the environment? I think the first thing we look for is, do we have liquidity and supply, not just from one client but from many? So the interesting countries for us over the last couple of years have actually been increased exposure to parts of Asia, including Taiwan and South Korea, which are now more established lending markets, although they do have some moving parts that you have to get over in order to lend in those markets. Other parts of Asia are also increasingly important in terms of exposure that our clients are now, in terms of investment rather, that our clients now have. So, in theory, any market is applicable if securities lending is allowed. I think that there is always an amount of work that you have to do as a fiduciary on behalf of your client to ensure that you're complying with entry to that market. And foreign investment is obviously very key to this, the ability for foreigners to invest openly and freely without restriction. And where that applies actually, because there are markets in Asia, for example, where there is foreign ownership restrictions, it does actually lead to a lending opportunity between the offshore stock versus the onshore stock. But in theory, we're looking for open and easily accessible markets where our investors are, because ultimately this activity is on behalf of our clients, and they have to be satisfied that we have, and they have on that we have on their behalf, I should say, have conducted our due diligence, and that they have a lucrative and meaningful experience in their country. Yes, interesting that we're entering the most mature and the market with the most longevity in securities lending. We have been in the US for many, many years. We just didn't have the local custody network that is one of the ambitions of the organization, to provide local custody in the leading markets in the world. That we achieved in 2012, and that led to a discussion about, well, how are we going to support clients that engage us locally, given that securities lending in the US is very typically a prerequisite, or certainly a requirement amongst the client base there. That led to us looking at opportunities, or certainly ways that we could satisfy that requirement, and we have now launched the desk in the US in recognition of two things. One, in support of our local client base, as and when we eventually attract new institutional clients there. The second thing is that this is obviously the largest single market in the world, and therefore the opportunities are extreme. There are so many providers there are so many institutional investors in the US. There are a number of well-established organizations providing them services, and I always think there's room for another one. Our early investigation and engagement with the industry there has absolutely welcomed our launch of this product. We are in the build-out phase, but we see two things happening from there. We will attract new clients who will have a mixture of both domestic assets and international assets. We also, of course, have a client base outside the US with US assets. And a combination of both of these factors, we think, will breed a lot of success as we now really complete the circle of having a full global presence in both Asia, Europe, and the US. Securities lending by its nature is a very competitive product, regardless of whether you're in the US or anywhere else in the world. And in fact, the fee splits that are typically the way that revenue is distributed between the beneficial owner and the agent has crept upwards over the years, there's no question. But we're also facing a slew of regulation which will have, or potentially has, the effect of making the provision of these businesses somewhat more expensive. Savvy investors and beneficial owners know roughly what the costs of securities lending are to the institution. There's a lot of transparency about custody pricing, and there's a lot of transparency about the cost of running securities lending as well. When you get to an outlier situation, which is extremely lucrative to the beneficial owner on paper, I think they have to ask themselves, is this institution really investing back in the business that they're providing to me? If this is so lucrative to me, what is the motivation, and how do they achieve or get to the point where it is at this level that doesn't seem to be producing a lot of revenue to the agent, who has clearly expenses. They have settlement costs, they have a number of functions and services they have to provide to me. So I think, certainly in my experience, I've been in a number of situations where we've had clients mention, or prospective clients mention, what they've been offered by others, but have firmly rejected those fees. So yes, there may be some activity in the US which is extremely poorly priced in terms of providing these services, Let's just see where that leads us to. We're very confident in how we're going to come about our pricing. I think our peers are also very aware and are providing good rationale as to why fee splits in the US need to remain perhaps where they are, or even, on occasion, because there is a debate about indemnification and the cost of that, these fee splits may change in the other direction.